Hi, Michael and Megan. Thank you for making time to come into the office today. Today, I'd like to go over your education plan and your different goals and objectives for the college educations for Ross and Jake. Going over your goals and objectives, Megan, you wish to provide funding for each of your children for 4 years worth of education costs. You would like to prepare them with $22,000 in today's dollars adjusted by 6% inflation. And we are to assume that all taxes will be paid out of current income, and investment income will yield a mix of 5-year and 10-year treasuries. The life insurance proceeds from your past husband, Scott, have been placed in an investment account, and those funds are also set aside for the children's education. At this time, your youngest daughter, Elisa's education is not a top priority. I'd like to begin by talking about the benefits of a 529 plan. 529 plans allow parents or grandparents or any individual to save for college in a tax-favored way. Post-tax dollars are contributed to the 529 plan, and that you are allowed to invest those funds into different securities that can grow over time. The growth over time is tax deferred if the money is distributed for a qualifying education expense. Some of those include tuition, books, and room and board. You only get the tax advantage of the 529 plan if the distributions are used for those qualifying education expenses. Otherwise, any gains on a 529 plan on the security that's sold, the gains will be taxed at ordinary income plus a 10% penalty. That's definitely something that we're going to want to avoid because that's a pretty steep penalty. To start the funding of your 529 plan, I would recommend that, Megan, you use some of the proceeds that you already have saved that are earmarked for education. Currently, your investment portfolio is worth about $210,000, and you have an education CD worth $22,747 for a total of $232,747. You have the ability to make annual contributions up to $14,000 to a 529 plan per child. So in the first year, you could potentially contribute $28,000, but you would also be eligible for what's called the 5-year gift. As a tax strategy, you would be able to make 5 years worth of contributions in the first year, totaling $70,000. That's $14,000 per year times 5, $70,000. That money can be allocated immediately into a 529 plan instead of having to contribute year after year. That way, you take the maximum benefit that you can of the tax deferral. Another advantage of a 529 plan is that you have the ability to change the beneficiary once per year. So if for some reason, and we will go through the calculations in a moment, but that you have leftover funds in a 529 plan for a particular child and all of their education costs are paid for, you are able to change the beneficiary of the 529 plan to a new child or one of your other children. As the owner, you maintain power over the account. The beneficiary is the person who you are saving the funds for their post-secondary education. And another benefit of a 529 plan is the effect it has on your when you apply for your FAFSA. The assets held in a 529 plan are not as strictly looked at as assets that would be held in a traditional investment portfolio like you have currently. If it's okay with you, I'd like to move into the calculations that were involved in determining how to save for your children's education. The first thing I did was determine the growth rate of your investment portfolio. Megan, you had told me that you'd like to have a 50-50 blend of 10-year treasuries and 5-year treasuries in your investment portfolio for your college education funds. When that yield is determined, when the average is taken, we find an 8% growth rate will be used. The first thing I did with that 8% growth rate is that I determined what your future dollars would be once Ross reaches the age of 18. The present value of your investment portfolio and your education funds your education CD total $232,747. At 8% over 4 years, that would total $316,649.72. At that time, when Ross reaches age 18, I've also calculated what his tuition costs would be. They would total to be $121,502.74. When Ross reaches age 18, we will set aside the funds that he needs for education in cash, set aside away from your investment portfolio so that they are not subject to risk. We know that this goal is very short term, and we do not want anything to happen to that money because we know that we are going to spend it. The next thing I did was determine what you'd have left after subtracting out Ross's total costs. The remainder after you subtract Ross's costs from your investment portfolio would be approximately $195,146.99. Between the time that Ross turns 18 and Jake turns 18 is 2 years. So we need to again grow the remainder balance by 8% for 2 additional years. That present value turns of $195,146.99 will turn into $227,619.44. At that time, when Jake is 18, the total costs for education are anticipated to be $136,520.49. That means that after his costs are set aside and removed from your education portfolio and held in cash, you would have a remainder of $91,098.95. Once Jake's education costs are set aside, we will have to make a decision on what to do with the remaining $91,000 and how to allocate it. I've come up with a few suggestions on how to handle the remaining proceeds. First, Megan, you could continue to fund Ross and Jake's education by continuing to hold the proceeds in a 529 plan for graduate school. You could also allow Ross and Jake to access the funds outright for their own personal use, to either fund their own retirement or to purchase a first home or to even start a family. Megan, you could also invest the remaining funds for your personal retirement and add them to your retirement portfolio. If we were to decide to do that, we would definitely have to change the allocation of the funds. Finally, my last suggestion would be for Megan to start funding a 529 plan for Elisa, or potentially change the beneficiary of an existing one to Elisa. At that time, she would be age 8. But ultimately, Megan, this will be your decision as the funds are held in your name. I'm sure involving Michael will be critical to determining what the best solution is, but at the end of the day, it's your decision on how to allocate the funds. If you have any questions, please feel free to call or email anytime. My phone number and email address are included in your investment packet. I hope you have a great day, and thanks for coming in the office.